Morning, everyone, and thank you very much for joining me. This is the morning market review. It's Friday, it's the 14th of October 2022. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is r@fxcm.com. Just going to go ahead and bring up our high risk investment warning. Just whilst this is on screen, just wondering if you guys can hear me and see the screen, if I can just get some confirmation there. Okay, excellent. Thank you. All right, here's our market commentaries disclaimer. And the references: Market Scope 2.0, Trading View, and Bloomberg. Let's put this chart up on screen just to let you know what you are looking at. Here's your core inflation. This is the median. Just want to check the median hasn't updated yet. Yeah. So we still we don't have the latest data point on the median. Just while this is on the screen, I'll go through the headlines. 5 things to start your day from Bloomberg. Bailey versus Kwarteng. Analysts predicted that the Bank of England Governor Andrew Bailey would be forced to reverse his vow to end the bank's £65 billion emergency bond buying facility this Friday as planned. Chancellor of the Exchequer Kwasi Kwarteng warned that it would be a matter of the governor if the rout extended into next week, but he then dashed back to London from the IMF meeting in Washington to deal with the mounting crisis. It's clear that Kwarteng's budget is unraveling and he has no choice but to prepare what could prove to be the mother of all U-turns. Next headline: reversal for the ages. So I don't know if you guys were as, I was going to say surprised at the market action yesterday. I think sort of gobsmacked probably the ideal word. It was a stock reversal for the ages, a near uniform plunge followed by an everything rally made for a dizzying day on Wall Street. The S&P 500 wiped out a 2.4% loss, marking the first time since July that it reversed a decline of 2% and closed a whopping 2.6% higher. Never before has the market experienced such extreme readings in both directions in one day, according to Bloomberg data going back to 1990. Whatever the reason, it's pain for bears who found their stance validated by a stronger print in the US Consumer Price Index with core inflation at a 40-year high, only to see their profits evaporate in a matter of hours. A very, very volatile market yesterday. Definitely one for the books. We're going to talk about it in a moment. Next headline: ECB balance sheet. Hawkish European Central Bank officials aim to start unwinding the institution's €5.1 trillion asset hoard by early 2023 while retaining interest rates as their primary monetary policy tool. According to people familiar with the matter, a consensus is emerging among some governing council members that the process of shrinking should run in the background while the ECB focuses on setting borrowing costs. ECB hawks have effectively dictated the momentum of monetary policy since early June, a dominance over decision-making that suggests their opinions might well continue to sway. This is a very, very important headline that we're reading. So 5.1 trillion on the balance sheet that's due to be unwound. That's a huge amount. So the Fed's doing 9 trillion. Okay, this is 5.1. So we're just going to have to watch how the market forces interact here, because this is a brand new variable now that's being introduced, and it's a complex one. So we're just going to have to watch that. Private bets. A shift towards private markets is cushioning many of the world's largest investors' from the wreckage wrought by runaway inflation and spiraling interest rates. The big question now looming over giants from China's 1.2 trillion sovereign wealth fund to California's public pension, the largest in the US, is how long those private bets will remain insulated as the economic outlook darkens. The 10 biggest global funds that disclose holdings in non-public markets doubled their combined weightings to assets such as private equity and credit, real estate, infrastructure, and hedge funds to about a quarter of their portfolio since the global financial crisis. So that's huge. So there's a huge movement out of conventional sort of assets into what's called alternative assets. It's a very specialized area, alternative assets. And the truth of the matter is, I'm not certain it's really hiding from the risks. So we just perhaps going to have to watch that as well. Could be something that actually adds to the systemic nature of the risk buildup. Caught in Credit Suisse. Mizuho Financial has emerged as a suitor for at least part of Credit Suisse's securitized products. I beg your pardon, for Credit Suisse's securitized products group, as the Swiss bank moves closer to a final deal, according to people with knowledge of the matter. The Japanese bank is competing against parties including Apollo Global, Centerbridge Partners, PIMCO, and Sixth Street. Credit Suisse has said the securitized products platform is highly profitable and employs about $20 billion in risk-weighted assets and roughly $75 billion of leveraged exposure, which is a regulatory measure of assets. It's due to unveil its strategic review results on October 27th. Coming up for this session, European shares are set to rally after US equities rebounded from losses that were fueled by a hot inflation report. Finland, France, and Spain also issue CPI prints today. The BOE's emergency bond buying is set to end. That's a big story. Keep an eye out for any headlines around that. I don't think it can end. I think there still needs to be some sort of involvement by the BOE here. ECB's Robert Holzman speaks at a conference. JP Morgan, Wells Fargo, Citi, and Morgan Stanley are the first major banks to report quarterly earnings. So effectively, this means that now Q3 earnings season officially starts today. So, I mean, we've got a few that have come out already, and they've been poor, just by the way. But the banks are out today. That's important. Hey, Howard. Nice to have you on the webinar. Thank you very much for joining. All right, so I want to keep an eye on this median inflation. I think this is for me, this is really a key focus. I think until we see the median rolling over, it's going to be very difficult for the core to roll over. It's a pity we don't have this data point here. But what we want to do is just throw in a correlation coefficient here. We're going to be missing the last data point, so just that's going to throw the correlation out. But let's just put it in. All right, so by and large, except for a few anomalies here, I have noticed that there's a few sort of weird kind of negative dips, but they're very short-lived. You can see that there's a positive correlation between the core and the median, which makes sense. Well, we're missing this last point here. Okay, so the correlation here needs to just be looked at again next week. But what this is saying, what this is suggesting, is that until the median, the absolute middle path of inflation starts rolling over, there's a floor. Okay, there's a floor underneath how much coal can actually disinflate. So this is a key relationship in terms of the macro environment that we're in, and as long as the median remains resilient, calls for a pivot really are just pipe dreams, you know. And if it builds, if the narrative builds, and the market responds to that narrative, but the core inflation hasn't rolled over, it's probably a good opportunity to exploit. So we're just going to have to wait for this extra data point before I can sort of make any real sort of inference. But the actual core number was very bad. I think there was just secondhand cars, I think, pulled back, I think, and there was one other. Everything else moved up. All right, let's take a look at the market action yesterday, which was absolutely confusing. But I actually think behind the confusion, we can come up with some sort of theory, and it comes back to the real rate. And you know, this is just a series that is not getting the sort of the exposure or the media time that it needs. So the daily here, you can see the real rate here coming down. As the real rate comes down, you can see that the Dow over here does that really amazing return. The price action was very surprising. And the obvious question that we need to ask ourselves is, well, why is real rates coming down, considering the sticky inflation that we received? And I think that it is technical in nature. I did read a few articles that suggested technical in nature, but which I would agree it's technical in nature, but they are looking at it from a different point of view than I would be looking at it. So the articles say, well, there's this technical support here, which is of course correct, but I think that it lines up with a weekly overbought condition on the real rate. And I think this is, for me, the more important technical influence, in that we're now coming to a very interesting time for real rates, because yesterday we said, well, I said, this needs to normalize. I cannot tell you when it's going to normalize. Nobody can tell you when it's going to normalize, because it's, number one, it's a weekly chart, which is inherently difficult because it can normalize over weeks. Secondly, it's not behaving as in previous overbought conditions were very brief. We now got to a stage where it is much more entrenched. So that in of itself makes it difficult. But we also said the normalization needs some sort of catalyst. And I proposed a potential catalyst would be November 2nd, which is the FOMC meeting, where it's kind of a buy the rumor, sell the fact type of market action. In other words, the likelihood of real rates moving towards that meeting, I think, are high, and then we might see the normalization thereafter. But of course, that's just it's sort of speculation at the moment. But the fact of the matter is, yesterday's price action, I think, did suggest that we are looking at sort of a buy the rumor, sell the fact environment for the time being. Why so? How come? Is because the rates have run so hard and fast that they do need to have this normalization. So even though the CPI was a dreadful number yesterday, it actually served as a catalyst for some sort of counter market action, in my view, suggesting that the market does recognize the fact that rates are frothy, does recognize the fact that there needs to be some sort of correction here. Whether it can do it or can't do it, I think, is an exceptionally difficult analysis, because the truth of the matter is we got this guy who just isn't rolling over, right? So until this guy rolls over, we do need tight policy. But there is a ambiguity, which we mentioned, and the obvious outcome of that ambiguity is a terribly difficult market environment. And we said that yesterday, and guess what? Yesterday was a terribly difficult day in the market, because the reversal was on sort of a sensible basis, nonsensical, right? So, but I think there is technical factors at play here. Ultimately, the key driver of markets remains inflation. That's gonna trump, I think, anything else. So even though there is a overbought condition here, the key question, which is very difficult to answer, is how does that overbought condition normalize in an environment which actually needs tight monetary policy? And we're going to have to watch how that unfolds, because I think that is going to be a very important movement in terms of market drivers, key market drivers, right? So it's very, very difficult market we're operating in. And I think that falls very much in line with what we've been saying. Q4 does have this weird probability that it can have a strong rally, a strong counter rally, technically speaking, even though variables still remain incredibly weak. So, and the drivers here, in other words, as we come down on the overbought condition, we may see the bear market rally, and that again is not, it's not definite. We're talking probability here. We're going to see how we're going to have to see how the probability unfolds, and we have to be quite savvy and nimble to move with it, or if it doesn't move, still to move with it, right? So the idea is we're going to just keep looking at this day in, day out, because I think it's going to be a key metric for us. The difficulty is going to be compounded if there is a bear market rally, and that bear market rally would be flowing into news articles where we could be fooled, and I'm going to put fooled in quotations here, that we are at a market bottom. And I say fooled because we don't know where the market bottom is, but until we get that COPOC picking up. So I'm going back to the COPOC. Let's bring that up. Okay, let's get rid of this guy. Okay, so COPOC must be on monthly. So we're going to be delayed here by a month or two. Let's make it logarithmic. Okay, which we're just going to have to be comfortable with, because calling a market bottom here is, I think, foolish. I don't know where it is. Nobody knows where it is, least of all journalists. So let's just throw this in here. And let's ping our signal line. going to try and save this up as a. I think I'm just going to have to do this every time. All right, it's not a big deal. Here's the it's a 3-period EMA. Okay. So let's keep an eye on that. There's no doubt that we are in value territory. There's no doubt. So value is starting to clearly show. What do I mean by value? Well, good companies that are going to be around for a long, long time are seriously depressed. Okay, so we're there, but I'm not sure if there is a case to be made that now's the time to go in. In other words, cheap companies can become cheaper. If we go back to the global financial crisis, you can see that it turned up. When did we turn up? At -66. Okay, we're only at -15 here. I don't know how deep the current leg down goes, but of course, it can still be quite a deep dive. And now we've got earnings season. And what we looked at yesterday was how inflation destroys margins, or the top margin, right, which is your gross profit margin. Companies then need to manage their operating margin, and the way they do that is that the most obvious way to manage operating margins would be to start controlling costs. And the problem with the inflation that we have right now is that it's insidious. So what I mean by insidious, it means that it's starting off stealthy, but the longer it maintains, the more obvious and chronic the effect on margins becomes. Means the more drastic the management actions are, which ultimately means layoffs, moving from trying to find properties that are cheaper, just a whole lot of actions which actually feed into the economic contraction. Okay, so this is the environment. So I think we still have some pain on the market side, and I think that any bounce here needs to be considered very carefully in terms of COPOC. Now, if COPOC does cross positively, if it does, we would have already had a few months of positive market action. Okay. COPOC it's a late indicator, but it turns up pretty close to the cycle low. All right, but even if it turns up, you just need to be a little cognizant that it's not flawless, right? It can turn up and then fall again. So we're going to have to be, again, just to sort of really emphasize the point, be savvy here, because the market is really, gee, this is a tough market. I think we would all agree on that at the moment. So just in terms of equity portfolios, I mean, I'm looking quite carefully just at sort of some local equities. No ways I'm going to be taking out any positions, but now's the time to see, where's the potential opportunities once we get to that renewed confidence stage. So just want to keep an eye on that. Yeah, all right, so Gurdeep is making an excellent point here. I think, Gurdeep, let's just explore that. So his point is the Fed may be data dependent, but to avoid easing, they will need to be sure unemployment is killing off inflation, therefore misery. I'm just thinking, I'm not sure I've got the full understanding of the point, so just correct me if I'm wrong. I think what you're saying there, Gurdeep, is they're waiting for unemployment ultimately to make the adjustment. And yes, I think that is a key point. So I think that's the point you made. Let's just explore that on two levels. So just to give you an agenda just for the next few moments, I just want to do something on, we'll just do a quick economic model on Microsoft Paint. I want to just look at that model with more realistic data series, and then we're going to start looking at some potential charts that we can look at for today. With the caveat, it's a very, very difficult market. All right, so let's I'm going to just bring up Microsoft Paint. All right. So we've looked at this previously, but I think it's just worth revisiting just what a stagflationary environment is. It's very important to understand. So just I think this is a really good way of looking at the current environment. We've got on the y-axis here, I'm just going to put inflation. And on the x-axis, I'm going to put in, let's call it economic growth. It's generally referred to, you guys, as real GDP, but we'll just put economic growth here. And I want to put in brackets here employment. So obviously employment is a key part of economic growth. Okay. And what we have here is aggregate demand. Yeah, we've got aggregate supply. And we're in sort of a weird type of environment where there was a supply shock, which I think is clearing to some extent. Okay. We're just going to have to differentiate this as AS1. Okay. Here's the initial. So let's call this. I'm just going to call this inflation 1. We'll call this. Let's call this just. Let's call this 0.1. And the supply shock has pushed inflation up here to inflation 2. But we're seeing so headline inflation. So I just want to make a very important point here. Headline inflation is reflected in the movement from AS to AS1. Core inflation is actually reflected in a movement in aggregate demand. This AD1. All right. So what effectively is happening here is the Fed is trying to move AD1 back to AD. That's what its interest rates are trying to do. But then it's got this, it's still dealing with this supply shock out, which I don't think has cleared because of the geopolitical crisis in Ukraine, Russia, supply chains in China, etc. To get rid of this AS1 here, the Fed has zero control. Okay, so the Fed's working on AD1 to AD, but from AS1 to AS, it's got zero control directly. It's got zero control directly, but it may have some control indirectly, and this goes to Gurdeep's point. One way for AS1 to shift back to AS, well, that will take place in the labor market. In other words, the adjustment in supply, in a tight supply, will take place in the generally in the with employees. In other words, the unemployment rate starts increasing, and as the unemployment rate starts increasing, we'll slowly start getting a shift back this way. So this is kind of the market force at work. That's obviously very theoretical. Let's just try and make it a little bit more practical and see if we can spot it. So this is something we've looked at before. We haven't looked at this recently, but let us bring in the core inflation here. Let's actually do it on the chart here. Okay, let's throw in now the Fed funds rate. Okay, we're going to put it on the same chart. I'm just going to make it a new price scale. All right, let's just zoom out here. Okay, so let's just understand what we're looking at here. Black line, core inflation. Orange line, I'll just make it a bit thicker, Fed funds rate. So that is central bank action. Okay. And here are our previous high inflationary periods. And you can see the Volcker years. Okay, these are the Volcker years here, but the Fed funds rate clearly following inflation higher. If there's anything that we can see here, we still, you know, it's quite a big lag, isn't there? The terminal rate is, or the median terminal rate at the moment is around about here, 4.6%, according to the dot plots, somewhere there. Okay, so that's kind of where they see the Fed funds rate, the interest rates heading towards. And now let's throw on a couple of extra things here. Let's throw in GDP. Okay, let's throw in GDP. Actually, I think I remember the code, yeah, because we haven't done it for so long. I don't remember the codes. US GDP, and we wanted year on year. Okay, let's put it on the new price scale here. All right, let's make this one a little easier to see as well. So the chart's getting busy, so if you just try and isolate with the colors, gee, this is really busy. So the red, gee, this is actually too much. You can see the GDP looking at red falling here. Okay, this is the first oil crisis. GDP falling here, so we start there, comes down to here. So GDP falls during the interest rate movement up and the inflation higher. Much easier to see here, so I can see it's very busy here, beg your pardon. But you can see that the GDP coming down here. So let's just understand what we're looking at. High core inflation, low GDP. That's stagflation, right? Now let's go to Gurdeep's point here. Well, what about unemployment? This is actually quite tricky. It's anomalous because the job market's been amazingly resilient during this cycle. So let's throw that in. Are we going to look at something called the U3 unemployment rate? which is it's what you guys are used to, but it's very narrow employment. I don't think U6 is here. Okay, let's put it on a new price scale. Gee, this is really busy. Okay, let's make this easier to see. Make it a blue, big blue. Okay. So the unemployment rate is in this blue. And the point is, well, if there has to be adjustment in the labor market, well, then unemployment's got to be increasing, right? And that did happen in the first, sort of the first oil crisis process, which, sorry, I'm a bit late there, which is here. Okay, so you can see the blue line kicking up, obviously here. Happens in the second. Unemployment obviously kicks up here. It's not happening at the moment. Isn't that strange? So we've got a very, very difficult market. The Fed's dealing with. So Gurdeep's point is, well, when is unemployment really going to? And I don't want to be sort of overly crude about this, but the fact is the adjustment takes place. A large part of the adjustment takes place in unemployment. Well, when's that going to happen? It's not happening right now. See that? It's not happening right now. So the Fed's in a very tough spot here. The adjustment mechanism of unemployment is not responding, or neither is median. And the obvious labor participation may be hidden unemployment. Very good point. All right, let's just bring it in as well. That's actually a brilliant point. I'm going to put this on a separate chart, don't worry. Okay, I'm going to put this underneath. Yeah, I thought it might be it's the correct one. Okay, good. Let's just make this. There we go. All right, and so what Gurdeep's saying is that isn't there some sort of unemployment inside returning to the participation rate? In other words, if you look at it, the participation rate compared to pre-COVID, it's still way down. And this is actually, I think, quite a interesting analysis, Gurdeep. I actually got to give it some thought. So what the participation rate is measuring is it's measuring people that are prepared to be counted in the labor force. There is a group of people they call discouraged workers, which are not part of the labor force. A discouraged worker believes that he or she cannot find a job, and there could be a variety of reasons for this. For example, that prior to being laid off, they may have been working in an industry that now demands new skills that they no longer have, so they are effectively unemployable, right? So that's that would actually be what's called structural unemployment. That's a big problem. But the point is that there is a definite lag here. I think there's other reasons for this, by the way. The remuneration, the sort of the COVID emergency program remuneration may have also caused a lag in people going back to cheers, Howard, have a good weekend, to going back to the office. But there's definitely a structural issue here. Whatever it is, you know, it's very as you can see, it's malignant. You know that this is going to be sorted out. It's a very poor, but I don't think it takes away. I don't think it takes away from the fact that this U3 line's got to kick up. Gurdeep, I'll tell you why. Is because the fact of the matter is, one way that you could perhaps get an adjustment in the labor market is by getting the participation rate up, because that would bring a whole lot of new workers into the labor force. But that's an excess supply. Well, to absorb that excess supply, theoretically, it should bring wages down. Theoretically, should, if they can get this participation rate up. But it looks to me as if it's structural in nature. So how do you fix structural unemployment? I think the most obvious way is educational programs. I'm just saying this on a very theoretical basis because I don't know what the structural issue is here. It's one I think that even policymakers are dealing with. But I would suggest that training programs could be beneficial. But the point is, it doesn't look like there's going to be much of a kick up in this participation rate anytime soon. So if there's no kick up in this participation rate anytime soon, well, you're still working with a labor force that's not adjusting to the current inflation conditions. So there is a complexity here added by the participation rate. How do you get discouraged workers back into the labor market? That's a huge question for policymakers. And if they can't do it, well, how does the labor market adjustment take place over here, which is making this inflation it's a huge problem as a huge part of the sticky inflation. You've got a limited labor force. I think their jobs now are starting to come down. I think the amount of jobs being offered is starting to come down, but I think the tight labor force here means that wages are elevated. That's part of that stickiness. Okay. Something definitely to watch. This blue line here is something definitely to watch. Okay, but it's actually defied the odds in my opinion. Really defied the odds in my opinion. If you any comments there, type those in. Gertie writes, political divide, stick or carrot, starve or mental health and childcare, elder care support. Yes, so childcare is part of the childcare is certainly part of the debate here. In other words, why is there sufficient childcare in the States so that children can be looked after while parents go back to work? So I have heard a few debates over that, but I actually haven't got any conclusive figures to work with for myself. So I'm not quite sure of the extent of that problem, but it's certainly up there in that debate, go deep. And just to elder care, something I haven't come across, but I would imagine it's very much part of that debate as well. Let's take a look at some charts, see what's happening, get a little bit more practical here. Okay, so this is interesting. So just taking a look at the US dollar, the US dollar is actually starting to show signs of strength into the morning session. Let's just see if there are crossovers here. Again, once we get those crossovers, does the US dollar start making its way to the upper quintile? And if that is happening, I would suspect that real rates are still very much driving that. If we take at the weekly, I mean, we know we're in a dollar bull market. See if it comes back into zone one. Okay, but if the dollar does cross here, and if we do make it through to the upper quintile, then I think, then we probably get a sell-off, not a bounce. Then I would suspect that despite the bounce on the US markets, Europe probably comes under pressure then. Let's just take a look at DAX. See, here's the DAX starting to roll over. So I'm not certain that article was 100% correct in that they're going to follow the US markets. The the price action yesterday was very confusing. Was very, very confusing. I think that looking for a bullish market just because yesterday price action was positive is a little bit, you know, a little bit simple. So let's just keep an eye, see if the DAX does cross down. If it does cross down, does it make its way through to the lower quintile? Now we'll just end off with the euro. If the dollar is starting to move, I would imagine the euro is starting to move. And we'll take a look at pound as well. And you can see it, indeed it is, isn't it? Starting to roll over. Okay. So if it's starting to roll over, does it make through to the lower quintile? Let's just do a top down here. So we know the momentum is down. We're still very much in no man's land here. But this chart, this daily chart here, is going to get very interesting. Just see the best way to, let's just take a look at euro US dollar here in a sort of a plain chart. I want you guys to keep an eye on this. So we're on the daily, not the weekly, but this could be a reference candle here. See that? This could be a reference candle here. It could be a, in other words, could be peak, trough, lower peak. Could be. That's something. Or what about this candle here, right? So this candle here could be the opposite. We could be trough, peak, higher trough. But what kind of candle is this? This is a very confusing candle. If you want to do reference candle work on this one, you're going to have to contend with the fact that it's a very long candle. We have addressed this in the past. It makes for complexity. What's the complexity? In that there could be a whole lot of candle action within this candle's range, but this is still the reference candle. So this, the highs and the lows of that reference candle still need to be watched. So we've got a interesting dynamic moving here. All right. Again, a hard week, a difficult week. Let's keep an eye on the crosses here. Let's take a look. Sorry, I wanted to look at pound as well. Okay, so pound also starting to roll over. This would actually probably be something I'd watch today with that article on the U-turn. I don't think any sort of U-turn would instill confidence, although it's probably ultimately something that, let me think about this carefully. Let's just say it may or may not work. Okay, so the pound US dollar, something to watch. Certainly we've got a downtrend here, and also tough chart, isn't it? It's just as tough. We're in no man's land here, border of zone 1. Very, very tough end to the week, guys. So just keep, I think, just keep sort of disciplined, patient. Don't chase anything. If you see the opportunity, make sure that your stops are in. Make sure that you're using proper risk management, and see how it looks on Monday. All right, I think we can end here. Are there any final questions before we log out? All right, let's wrap up here. Thanks, and you have a great weekend yourself. Thank you, everyone, for joining. Have a terrific weekend. We'll catch up on Monday morning. Thanks very much.